Rubis is an independent French company specializing in energy distribution and storage. Founded in 1990, it operates in over 40 countries across Africa, Europe, and the Caribbean, distributing petroleum products, operating service station networks, and providing storage solutions for various liquid products through subsidiaries like Rubis Energy and Rubis Terminal. The company is also expanding into renewable electricity production, particularly solar power. Energy distribution. Rubis distributes petroleum products including fuel for service stations, commercial fuel, LPG, and bitumen. Its retail network includes over 1,100 service stations in its regions of operation. Storage. Through Rubis Terminal, the company provides bulk liquid storage for petroleum, chemical, and agri-food products, and is a leader in France and has operations in the Netherlands, Belgium, and Turkey. Renewable energy. Rubis has invested in renewable energy, primarily developing and operating ground-based and rooftop solar power plants. Geographic reach. Its operations span three main regions: Africa, Europe, and the Caribbean. Acquisitions. The company has grown through a strategy of direct investments and acquisitions, such as the 2011 acquisition of Chevron's assets in the Eastern Caribbean and the 2019 acquisition of Cobalt in Uganda. Related investments. Rubis has also made strategic investments in other energy companies, such as becoming a significant shareholder in HDF Energy, a developer of hydrogen-to-power plants. Rubis SCA, RUI.PA, presents a compelling investment case, characterized by a fundamental disconnect between its consistently strong cash flow generation and its moderately volatile statutory earnings. The current market valuation, featuring a trailing price-to-earnings ratio (PE ratio) of approximately 8.67 times, reflects market skepticism regarding short-term earnings volatility and the execution risk associated with the group's strategic pivot towards renewable energy. Despite these perceived risks, the company demonstrates exceptional operational resilience, underpinned by a highly cash-generative energy distribution segment and a robust balance sheet position following strategic deleveraging. The central investment thesis posits that Rubis is fundamentally an undervalued high cash conversion entity. The safety of the current high dividend yield, which stands at a forward 6.36%, acts as a critical compensating factor for shareholders while the company executes its ambitious strategic transition plan. The core financial integrity, evidenced by a substantial surge in cash flow from operations (CFO) and a conservative corporate leverage profile, suggests that the market's reliance on the depressed PE multiple misrepresents the true underlying economic performance and dividend sustainability. In fiscal year 2024, the company recorded a headline contraction in group EBITDA, which fell 10% year-over-year to €721 million. However, this earnings contraction was significantly offset by superior working capital management, driving cash flow from operations (CFO) to surge 18% to €665 million. This massive cash flow generation confirms that the business model, primarily focused on the distribution of multi-energy services across high-growth markets in Europe, Africa, and the Caribbean, successfully converts accrual profits into deployable cash with extremely low leakage. This strategic maneuvering was further enhanced by the successful divestiture of the Rubis Terminal joint venture. The proceeds from this sale, completed in October 2024, allowed Rubis to strengthen its capital structure. Crucially, the corporate net financial debt, corporate NFD, was reduced, leading to a highly conservative corporate NFD to EBITDA ratio of 1.4 times. This financial strength provides the necessary capital capacity to fund the accelerated development of the renewable electricity production segment, Photosol, which is targeting over 2.5 gigawatts peak (GWP) secured portfolio by 2027. This structured approach isolates specific project risks associated with renewables expansion through non-recourse debt, maintaining the core group's credit strength and ensuring capital is readily available for strategic growth. Analysis of profitability and margin structure, income statement. The income statement analysis for fiscal year 2024 reveals a mixture of resilience in core pricing power and strategic short-term earnings pressure related to both operational headwinds and growth investments. IIA, Revenue and Gross Margin Performance. Group revenue for FY 2024 stood at €6,644 million, representing essential stability year-over-year, 0% growth, compared to €6,630 million in FY 2023. Although the reported TTM revenue in USD terms saw a decrease from $7.32 billion in 2023 to $6.91 billion in 2024, this discrepancy is largely attributable to minor currency translation impacts or lower commodity input prices that were effectively passed through to consumers. The group's ability to protect its margins remains a key strength of its business model. The gross profit margin stabilized at 25.6% in 2024, exhibiting continuity with the 2023 margin of 25.4%. This stability represents a robust recovery from the 5-year low margin of 20% recorded in 2022. This resilience confirms the operational efficacy of the Energy Distribution Division's commodity price pass-through mechanisms. As a reseller of energy products, Rubis is typically able to largely pass higher commodity prices to consumers and, conversely, absorb lower prices through its cost base, thereby stabilizing gross profitability, regardless of oil price volatility. IIB, Dissection of EBITDA Contraction. The overall 10% contraction in group EBITDA to €721 million in FY 2024, down from €798 million in 2023, was not uniform across the portfolio, but rather concentrated in specific operational and strategic areas. The dominant segment, energy distribution, contributed the majority of the operational earnings at €731 million, a decline of 8% from the previous year's €797 million. This decline was primarily driven by adverse performance in the Africa region, which saw a significant 32% decrease in EBITDA. The operational challenges in Africa stemmed from volatile supply contexts and regional market factors. For instance, in the first half of 2024, the Africa region experienced a substantial negative movement in gross margin of 30%, reflecting tighter margins and logistical difficulties, particularly in the bitumen shipping activity, which saw volume and gross margin drop significantly in the third quarter due to vessel dry docks. Conversely, regional diversification provided a crucial offset. Performance in Europe, which benefits from a strong positioning in liquefied petroleum gas, LPG, accounted for over 90% of regional gross profit, recorded a positive EBITDA growth of 6%. The Caribbean region also maintained stable performance, delivering 2% growth in EBITDA. This multi-country, multi-segment positioning between retail and marketing and upstream support and services allows the group to absorb regional difficulties and demonstrates the resilience embedded in its diversified model. IIC, the strategic cost of growth in renewables. The renewable electricity production segment, Photosol, contributed €26 million to EBITDA, marking an 11% decrease from €29 million in 2023. This drop was not indicative of a fundamental failure in the strategy, but rather represented a necessary cost associated with executing the 2027 strategic plan. The reported decline was attributed to short-term factors, including adverse weather conditions, lower load factors, local hailstorms impacting panels, and a temporary decrease in power spot prices. More significantly, the decline resulted from the intentional acceleration of development costs aimed at securing future gigawatt capacity. Rubis is proactively expensing these development costs now to rapidly expand its secured portfolio, targeting more than 2.5 gigawatts peak by 2027, primarily located in key European markets, like France, C2.2 gigawatts, Italy, C100 megawatts, and Eastern Europe, C150 megawatts. 7. The market is effectively observing a strategic short-term accounting pressure, lower EBITDA, which is a direct precursor to long-term asset value creation and future earnings growth. ID, Net Income Insulation. Despite the more pronounced 19% drop in earnings before interest and taxes, EBIT, which fell to €504 million, the net income, group share, was insulated, declining by only 3% to €342 million, down from €354 million in 2023. This relative stability below the operating line was achieved through successful management of the financial result. Specifically, management mitigated foreign exchange (FX) losses in certain volatile African operations, notably Nigeria and Kenya, during the second half of 2024, positively impacting the overall financial performance and insulating the final net income figure from a steeper deterioration. Furthermore, the financial result is expected to remain robust, partially offsetting the EBITDA underperformance. 15. 3. Evaluation of capital velocity, cash flow statement. The analysis of the cash flow statement unequivocally demonstrates that Rubis's true financial strength lies in its exceptional capital velocity and cash generation capabilities, which substantially exceed statutory accounting earnings and serve as the foundation for shareholder returns and strategic growth. 3. A. Surge in operating cash flow and efficiency. Cash flow from operations, CFO, showed spectacular growth, increasing 18% year-over-year to reach €665 million in FY 2024, up sharply from €563 million in FY 2023. This surge was not driven by operating earnings, which declined, but was underpinned by successful working capital optimization and lower working capital needs. The significant rise in cash flow relative to the much smaller change in net income points to a highly successful management of the cash conversion cycle. While the magnitude of this working capital improvement may not recur annually, the achievement suggests heightened management control over inventory, receivables, and payables within the supply chain. This enhancement should serve to stabilize the baseline CFO at a sustainably higher level going forward. 3. B. Robust free cash flow generation. The group maintained disciplined capital expenditure, CapEx, which decreased 13% to €248 million in 2024. The confluence of the surging CFO, €665 million, and the controlled CapEx resulted in a robust free cash flow, FCF, of approximately €417 million in FY 2024. This impressive FCF figure translates into a strong free cash flow margin of 6.28%. Critically, the FCF, €417 million, significantly overshadows the reported net income, €342 million. This high cash conversion ratio confirms that FCF is the superior and more reliable metric for assessing Rubis's financial health and valuation, rather than volatility-prone accrual earnings. 3. C. FCF as the transition fuel. The FCF generated is the primary funding mechanism for the group's energy transition. The €417 million generated in FCF in 2024 provides substantial internal funding capacity. This internal surplus ensures that Rubis can finance its entire capital expenditure program, €248 million, while simultaneously maintaining its dividend payout, substantially reducing dependence on external, potentially dilutive, financing. 17. The residual cash flow, supplemented by financing cash flow, which was negative €111.42 million, was used for strategic deployment, including both the growth investments reflected in the negative investing cash flow of €247.86 million, and the return to shareholders, which included an exceptional interim dividend of €0.75 per share paid in November 2024, funded by the Rubis terminal sale proceeds. 4. Structural integrity and leverage profile, balance sheet. The Rubis balance sheet demonstrates exceptional structural integrity, particularly following the deliberate deleveraging actions taken in 2024. The strategic management of debt composition ensures that the core corporate structure remains resilient while capital-intensive renewable projects are funded. 4. A. Debt reduction and core leverage strength. Total assets remained substantial, recorded at €6.73 billion in 2024. Total net financial debt, NFD, decreased by 5% year-over-year, settling at €1,292 million at the end of December 2024. This total NFD results in a total NFD to EBITDA ratio of 1.9 times. The critical measure for assessing corporate financial health is the separation of corporate debt from project-specific financing. The core metric, Corporate net financial debt, corporate NFD, which excludes non-recourse project debt, decreased 13% to €861 million. This deliberate reduction translates to a highly conservative corporate NFD to EBITDA ratio of 1.4 times, a ratio that remained stable compared to the end of FY 2023. The stability of the 1.4x corporate NFD/EBITDA ratio is a strong signal of financial discipline. This stability was achieved despite the 10% decline in the EBITDA denominator, underscoring the substantial financial benefit derived from the Rubis terminal divestiture proceeds, which were used to preemptively deleverage the core corporate structure. 4. Debt composition and capacity. The composition of the debt profile is structurally sound for a group undergoing an infrastructure-heavy transition. Of the total NFD, €1,292 million, €431 million is classified as non-recourse project debt. This structural choice is intentional and prudent, isolating the financial risks associated with the long-duration, large-scale power projects of Photosol from the corporate credit rating and overall balance sheet integrity. The resulting 1.4x corporate NFD/EBITDA is exceptionally low for a company engaged in a significant capital expenditure cycle and provides substantial corporate dry powder. This conservative leverage level allows Rubis flexibility to pursue further synergistic acquisitions within the energy distribution sector or rapidly scale up the Photosol development pipeline should market opportunities arise, all without risking a breach of typical institutional leverage limits, which are often observed in the 2.5x to 0x range for utility and infrastructure assets. The company also maintains a healthy liquidity position, reporting cash and cash equivalents of €666.37 million in FY 2024. 5. Dividend safety and payout sustainability. Rubis has established a long history of return in capital to shareholders, having paid dividends for 27 consecutive years. The group's dividend policy remains a core component of the investment proposition, particularly given the high yield. 5. Earnings coverage and payout ratio. The proposed dividend per share (DPS) for FY 2024 is €2.03, representing a modest 2.5% increase over the 2023 dividend of €1.98. With the current share price, the forward dividend yield is 6.36%. Based on statutory earnings, the payout ratio is reported in the range of 57.89% to 79.21% of net income. While the upper end of this range might suggest limited flexibility based purely on net income, this coverage is acceptable for a mature infrastructure-like distribution business, particularly considering the below-the-line pressures that constrained the net income figure in FY 2024. VB, free cash flow coverage, the safety buffer. For Rubis, free cash flow, FCF, provides the definitive assessment of dividend safety. With an FCF of approximately €417 million and based on an approximate share count of 103 million, the FCF per share is estimated to be around €4.05. Comparing the proposed DPS of €2.03 against the FCF per share of approximately €4.05 confirms that the dividend is covered roughly 2 times over by operational cash flow. This cash payout ratio of roughly 50% relative to FCF is highly conservative for the sector and demonstrates a robust safety buffer. Management has explicitly reaffirmed its confidence in dividend growth for the future, providing strategic assurance that maintaining and increasing this high yield stream remains a priority even while accelerating the energy transition strategy. This significant retained FCF surplus is crucial. It means that Rubis can finance its entire strategic capex program, €248 million, and sustainably maintain the current dividend without exerting pressure on its balance sheet leverage or resorting to external dilutive capital raises. This confirms the self-sustaining nature of the group's core business model, which can simultaneously deliver high income and future growth. VI, Valuation Analysis and Investment Recommendation. Rubis currently trades at €31.94, corresponding to a market capitalization of approximately €3.3 billion. The reported PE multiple of 8.67 times places the company significantly below typical European utility and infrastructure peers. VIA, the discount narrative and mispricing. The prevailing low PE multiple and high dividend yield are characteristic symptoms of a conglomerate discount or an earnings quality discount. The market currently appears to struggle with the valuation of Rubis due to two primary factors: earnings volatility and geographic risk. Short-term operational headwinds in key geographies, particularly the 32% decline in Africa EBITDA, introduce uncertainty that depresses earnings visibility. Strategic transition. The market is applying a heavy discount factor to the complex, capital-intensive photosol growth unit, failing to fully recognize the stable, cash-generating core energy distribution or the value of the embedded renewable pipeline. The analytical perspective, however, requires focusing on the robust, low-leveraged balance sheet and strong FCF generation, suggesting Rubis is mispriced. The low PE ratio does not account for the quality of the cash flows that underpin the balance sheet strength and dividend safety. VIB, Analyst Consensus and Upside Potential. Analyst consensus rates Rubis with a moderate buy recommendation. The average 12-month price target is €38.70, 20, with some projections estimating a target price of €37.32. Based on the current trading price, this suggests an expected capital appreciation potential ranging from 13.5% to 16.2% over the next year. Near-term consensus projections anticipate revenue stability, 0.37% growth next year, but project an earnings per share (EPS) contraction of 8.05%. This projected earnings pressure confirms that analysts recognize the transitional challenges and the effect of ongoing growth expenditure in photosol, which will continue to weigh on short-term reported profitability. The key valuation catalyst is the successful execution of the photosol roadmap. The development pipeline, targeting over 2.5 gigawatts P secured by 2027, represents embedded growth optionality. If the core distribution business, high-yield, stable cash, were to be re-rated even modestly, moving closer to peer multiples, and the photosol portfolio were valued as an independent infrastructure pipeline based on its secured gigawatt capacity, the resulting sum of the parts valuation would justify and likely exceed the current consensus price target of €38.70. The current low PE suggests the market is effectively paying nothing for the future growth embedded in the renewable portfolio. VIC, Governance as a Future Catalyst. It is relevant to note the announced governance changes and the management transition plan. The statutory managing partners, Gilles Gobin and Jacques Rieu, are scheduled to step down from their individual positions on the management board from 2027, with the appointment of two new managing partners. Successful execution of this management succession planning signals corporate maturity and a focus on long-term institutional stability. This de-risks the perception of a founder-led company and often serves as a catalyst for valuation re-rating by demonstrating stability beyond key individual executives. V7, Final Conclusion and Recommendation. Rubis SCA is positioned as an attractive income growth hybrid investment. The group combines a structurally high, safe income stream supported by an FCF coverage ratio of approximately 2 times, with significant capital appreciation potential driven by strategic repositioning toward renewable energy infrastructure. The defining attribute of Rubis is its exceptional cash generation power. The surge in cash flow from operations to $665 million in 2024 provides a substantial and structurally reliable defense mechanism against operational volatility and ensures that the energy transition strategy is overwhelmingly self-funded. The balance sheet, with a corporate net financial debt-to-EBITDA ratio of 1.4 times, is robust and affords ample capacity for continued strategic capital deployment. The current depressed PE multiple of 8.67x represents an unjustified discount to the group's intrinsic value and underlying cash generation capability. The path to valuation re-rating is continuous, verifiable execution of the photocell growth plan, targeting the secure deployment of over 2.5 gigawatts P by 2027. Rubis is recommended for investors seeking high, secure income streams combined with significant embedded value appreciation potential tied to the successful scaling of its renewable energy portfolio. The primary catalyst for valuation realization will be observable progress against the photosol capacity targets over the next 24 months.